Welcome back to my channel. I hope you're all doing well. In today's video, I'm going to break down three high yield income ETFs. And I know on YouTube, many people have already made lots of videos about these funds, and some of them have covered things like assets under management, distribution yield, and share price. But to me, this information isn't very useful in helping me determine which of these funds is best to add to my portfolio. So, in today's video, I'll break down some info, provide you with some valuable insights to determine which of these funds is the best high yield income ETF for 2025. So, starting with a brief overview, all of these funds sell synthetic options that expire on the same day. And XCTE has exposure to 500 leading companies, most of them are US based. QDTE has exposure to non financial growth companies, and many of them are tech companies. And RDT has some exposure to small cap US companies. Now, if we look at the 1 year performance and total return, you can see that in orange, QDTE comes up on top at about 25.5%. And I think it's one reason why this fund is the most popular out of all three. But if we look at more recent data, it might tell a different story. Now let's look at the year to date return. You can see that QDTE still comes up on top at about 10.7%. But if we look at the 6 month return, RDTE starts to catch up. And in the 1 month return, RDTE actually surpasses QDTE in total return. Now, will this trend continue? It sort of depends on the impact of interest rate cuts and what's going to happen in the next few months. But if we switch the topic just a little bit and look at the dividend chart, now when you see these dividend charts, and sometimes to me, I think, wow, that's a high yield. But what does that mean in terms of how I'm going to get paid or how it's going to help me retire? So, what I did was I collected data and I tried to translate what do these yields really mean in terms of monthly payments. So, I looked at April, May, and June of 2025 and I collected information to determine which of these three funds pays out the most and the least each month. And you can see that generally RDTE comes up on top. And if we look at July, August, September, the trend's still the same. RDTE pays the most out of all three funds. Now, interestingly, although QDTE is the most popular fund by assets under management, it generally pays the least. And I think that's really interesting because when you're looking at yield or weekly pays, it's kind of hard to determine if this is really going to help me. But if you add up all of the week's payments into a month distribution, you start to see some bigger differences. For example, if we look at August's distributions, you can see that RDTE paid about $1.33 per share, and QDTE paid out about $1.13 per share. So if you had 1,000 shares, that means there's a $200 difference between RDTE and QDTE. And if you have even more shares, that could be the difference of paying rent or not paying rent, or having extra money to buy groceries or take a trip. So I think it's important to see the weekly distributions on a month, 6 month, and year perspective. Now, it's easy to understand why RDT pays more because the Russell 2000 is more volatile, and higher volatility equals higher premium. And one way to think about this is selling insurance on a race car pays more than selling insurance on a family sedan. And I know it's not quite the same, but that's what I think about in terms of premiums. Now, changing the topic a little bit and talking about interest rates, I think this is going to have a big impact in the next few months. Now, interest rate cuts, in terms of mid cap and small cap companies, tend to be more sensitive to changes in these rate changes. And so smaller companies rely heavily on borrowing to fund their operations and growth initiatives. Unlike large cap or big companies that have a lot of cash on their balance sheet, smaller companies really have to be more strategic in how they borrow money. But when interest rates cut, that means debt is cheaper. And so when rates are cut, borrowing costs decrease. This may translate into increased net profit, and this might actually catch the attention of some investors. So what's the verdict so far? Well, looking at the data that I showed earlier in the video, for long-term total return investors, XDTE or QDTE might be a better fit. But you know what? If you're really interested in total return, you might as well go with something like Netflix because in the last year, Netflix has returned on a total return basis close to 60%. But if the goal is to generate maximum consistent income from your portfolio, then RDT actually could be the best option. And honestly speaking, just looking at the, last few months data, RDTE might actually outperform in terms of total return if the interest rate cuts really help small cap and mid caps perform better and increase volatility. But I'm no fortune teller. These are just some things that I've noticed in the last few months, and I wanted to share with you. Okay, well, I hope you got some value out of these videos. If you found anything helpful, like that button. And if you want to follow to watch more videos on how I break down financial products, subscribe. Let me know in the comments below which covered call ETF you're considering for your portfolio. Thanks again for watching the video, and I'll catch you in the next video. This video is for entertainment purposes only. It is not intended as financial advice. Consult with a qualified financial advisor before making any investment decisions.